Welcome to Acera's new employee / mid-career seminar. So in this seminar, we're assuming that you're either new or you're somewhere in the middle of your career, hence the name of the seminar. So the bottom line there with the title is that you're not yet near retirement. Retirement is a ways off, which is a good thing because it means you still have plenty of time to plan for your retirement. So in this seminar, I'm going to tell you all the things that you might want to know about doing that planning. And since you're curious enough about retirement planning and about the benefits that you're earning to watch this, you probably have some questions. Questions like, what do I need to know about my pension? Do I need to do anything? And if I need to do anything, what do I need to do? So we're going to answer all of those questions for you today. I have arranged the presentation and therefore the answers to all those questions in the form of this checklist. So we'll cover all of these things today. First off, I'm going to help you understand some retirement basics. Then we'll talk a little bit about helping you understand pension math. And I'll show you our retirement formula. It's super easy. It's not complicated. It's a simple multiplication. So if you don't enjoy math, don't get worried because it's not that bad. And then we'll talk about purchasing service credit in that part of the presentation. Okay, then I will help you get a pension estimate. So I'll show you how to do that. I will also help you understand when you actually become eligible to retire, because there are some requirements that you need to meet before you're eligible to retire. I'll help you understand some additional benefits that we offer, like healthcare benefits when you retire. I will talk about designating your beneficiary or beneficiaries for your death benefits. We'll talk about some career planning options. We'll also talk about making a retirement planning picture. So this is kind of drawing a picture of the future. And as part of that discussion, we will talk all about opening a 457B account, which is an option you have as a government employee. And I'll briefly talk about signing up for Acera News. Okay, let's jump right in. Let's talk about understanding some retirement basics. First topic. Okay, so I'll start at the beginning of the story. Who is Acera? In one sense, Acera is this acronym that stands for Alameda County Employees Retirement Association. But it's made up of a lot of people. So there's about 90 of us that work at Acera, and what we do, our entire job, is to provide retirement, disability, and death benefits to our members. And that's all of you. So you are also part of Acera. And you're part of Acera because of the position that you work in and who you work for. So your position is either currently full-time or at some point in the past was full-time, and it's a retirement eligible position. And that position is working for one of the 6 employers that participate in Acera. These are the county and other local county agencies that use Acera to provide retirement benefits to their employees. So we have Alameda County, Alameda Health System, Superior Court of California, First 5 Housing Authority, and Livermore Area Recreation and Parks District. So as a employee of one of these agencies, working or at some point worked full-time in a retirement eligible position, you automatically are an Acera member. You automatically became an Acera member. And as an Acera member, you contribute to Acera's fund. So every time you get paid, something called employee contributions to the retirement fund comes out of your paycheck and goes into Acera's fund. And here's a screenshot of what that might look like on the county's pay stub. So you'll see it in the before tax deductions column, and it will say something like retirement, and then there's a little bit of money that comes out of your check and goes into Acera's retirement fund. Every time that happens, your employer is also making a contribution on your behalf. So we don't want those contributions to just sit around and collect dust. We want to earn some interest on those contributions. So we invest your contributions in a diverse array of investments all over the world, and we earn quite a bit of interest on that. And it's these 3 sources of income that give us this big pool of money that we call Acera's fund. So what do we do with that money? Why are we collecting this money? Okay, meanwhile, you are working in your job, in your full-time retirement eligible position, or just in your retirement eligible position. And while you're working in your job, you're earning credit toward retirement throughout your entire career. At some point in the future, you are going to retire. And that's when you stop earning credit toward retirement and you start collecting your retirement in the form of a lifetime monthly retirement allowance. What that means is that you will get paid a certain dollar amount every month for the rest of your life. You cannot outlive your Acera retirement. It's a really amazing thing. And to say a few more words about how special pensions are and how amazing this thing is, this benefit, this lifetime retirement allowance that you are going to get to collect when you go to retire every month for the rest of your life is not something that a lot of people get to participate in. And let me illustrate this by saying that when you go to retire, everything you paid into the system throughout your entire career, through those employee contributions, everything you contributed to the fund, we're going to give you back within the first 3 to 5 years of monthly retirement payments. Everything after that is like this amazing bonus that you get to have because you participate in a defined benefit pension plan like Acera, and you get to the special benefit is that it's a secure retirement that you can count on every month for the rest of your life. And it's actually the investment earnings that pay for 75% of your retirement. So basically, you're deferring your wages. We're investing them. We're earning a lot on those investments. And then we're using that deferred wages plus what we earned to pay you a lifetime retirement allowance. So it's a pretty special thing. Okay, there's a question up on the board. As a new employee, how can we validate that we signed up properly and you require no additional information? One way to validate it is to look at your pay stub and make sure that the retirement is coming out of your pay stub. That's the basic way to do it. If that's happening, you're a member of Acera and you're good. Now, if we need additional information from you, we'll contact you. So you'll hear from us. And one thing that you will hear from us is maybe 10 weeks after you start work, you'll get a letter from us in the mail that is suggesting that you should sign up that you should go ahead and create an account on our website. And then once you log in there, you'll see the pension data that's happening for you, and you'll be able to run retirement estimates and all that. Okay, there's a question. Why is Acera mandatory? Good question. I think it's probably because if it wasn't mandatory, a lot of people wouldn't do it, and then they would be in a really tough spot when they go to retire. And I think in order to make the whole system work efficiently, it just, works better to have everyone participate. And in general, these systems are set up that way. Those are just kind of some ideas off the top of my head. I'm not actually sure what the answer to that is, but that's how this system was set up in 1948. So it's been running this way since 1948. Okay, so let me show you this pension milestone chart here. These are some of the milestones you can expect during your membership with Acera. The first one is your date of hire. For many of you, this is the first day that they told you to show up to work in that full-time retirement eligible position. Now, if you started out part-time or in some other capacity for your employer, this date of hire would then be the first day that you worked in your full-time retirement eligible position. Okay, so then the next thing that happens is for almost everyone, 2 weeks goes by. And the first day of your second pay period, that is your date of entry into Acera. This is your first day of Acera membership. This is when you start earning that credit toward retirement. There's a couple of our employers, I think it's Livermore Area Recreation and Parks District and the Housing Authority, that these two dates are the same. Your date of hire is actually your first day of Acera membership, but for everyone else, there's a 2-week lag. Okay, now you're an Acera member. You've entered Acera. You started earning credit toward retirement. If you're working full-time, what happens is 5 full-time years go by. and you're considered vested in the retirement system. And vested, it's not a super important concept. Basically, what it means is it's the 5 years is one of the basic requirements that gets you to retirement eligibility. That investing kind of means guaranteed. So once you pass this milestone, you're guaranteed the vested benefits. You're basically guaranteed the guaranteed benefits. Okay. Then at some other point in the future, the next milestone is going to be based on some combination of your years of service credit. So basically how long you've worked in this position and your age. And there's a few different combinations that will get you to retirement eligibility. I will show you those a little bit later in the presentation. But this would be the first day that you are actually eligible to retire. And you can retire on that day if you want to. Or, as many people do, you can pass that retirement eligibility date, keep working, keep earning more credit toward retirement. At some point on or after your retirement eligibility date, there's going to be your retirement date. This is a date that you choose to retire. When you are satisfied that you have earned enough credit toward retirement, or else you're just, done being here and you're ready to retire. So this would be the date that you stop earning credit toward retirement and start collecting that monthly lifetime retirement allowance. Now, there's 2 more milestones on this chart, as you can see. That's not the end of your milestones. You're going to collect your lifetime monthly retirement allowance until your death. So that's what it means to collect a lifetime retirement allowance. That's when your retirement payments stop. But at the time of retirement, you will make a choice of different retirement options, and some of the options allow you to leave a continuing payment to a beneficiary for the rest of their life, which means at your death, your beneficiary will start collecting continuance payments every month for the rest of their life. And that's when the benefits stop after the beneficiary dies in that scenario. A little bit more about vesting. I just told you it kind of means guaranteed, and the guarantee comes from this 1937 Act Employees Retirement Law. That's a state law. So it's the state law that tells us how to run a SERA, tells us who gets benefits, who's eligible for benefits, and tells us, how to do every aspect of a SERA. And that's where the guarantee comes from. And the guaranteed benefits are a monthly retirement benefit for the rest of your life. That's the lifetime retirement allowance that I've been talking about. I'll throw around a lot of terms here. Retirement allowance, retirement benefit, pension benefit, lifetime monthly retirement allowance. These are all synonyms for the same concept, which is this monthly payment you'll get on the last business day of the month, every month for the rest of your life once you retire. There's also an annual cost of living adjustment, which is a percentage increase to that retirement allowance in retirement. That's a guaranteed benefit. And then there's a $1,000 lump sum death benefit. Let me tell you about your tier. You all belong to one of these tiers. These are the different tiers that are in a SERA. And it's based on your date of entry into a SERA. This is your first day of a SERA membership. Okay. So you're going to look at one of these timelines, and to find which timeline you're on, first of all, you are either a safety member or a general member. Now, safety members, you know who you are. You are sheriff's deputies and probation officers, and there could be some other sworn officers in there. Everyone else is a general member. So safety members look at the bottom timeline, general members look at the top, unless you're a general member for the Housing Authority or a general member for Livermore Area Recreation and Parks District. And then you will look at the timeline that is appropriate to you for your general membership. Okay, now the way it works is if you entered a SERA before each one of the cutoff dates, that puts you in the tier before the cutoff date. So if you entered a SERA before July 1st, 1983, that would put you in tier 1. Now, since this is a new employee or mid-career webinar, there's probably not a lot of tier 1 people here, if any. So there may be some tier 2 people. If you entered a SERA between July 1st, 1983 and December 31st, 2012, because you would have to enter before the cutoff date, that would put you in tier 2. And in all cases, if you entered a SERA January 1st, 2013 and beyond, that puts you in tier 4. Okay. And then you can see there's a slightly different cutoff dates for the Housing Authority, Livermore Area Recreation and Parks District. And one thing that I'll point out is if you have reciprocity, when you enter a SERA, if you have linked a different retirement system together with a SERA, a reciprocal retirement system, in another California retirement system, you may be able to get into an earlier tier based on your date of entry into that earlier system. So we'll talk about reciprocity later on in the presentation and linking different retirement systems together. But that is one way that is one thing that could put you into an earlier tier. Okay. So now I'm going to show you this slide to give you kind of some context for greater context for our entire discussion. When you go to retire, financial planners say that in order to maintain your standard of living in retirement, whatever standard of living you were enjoying right before your retirement, in order to maintain that standard of living, you are going to need in retirement 70 to 80% of whatever salary you were making before you retired in order to maintain that standard of living. Okay. Now that income in retirement can come from a few different places. Your SERA monthly pension or any other pensions that you have from previous employment with other public agencies that have pensions, Social Security, and then anything beyond that is going to be your personal savings and investments. Now, if you are a new employee, or even if you're in your mid-career, that could sound a little onerous. Like how the heck am I going to get there? But just like take a breath. It's actually not that difficult of a procedure to get you pointed in the direction of 70 to 80% income replacement in retirement. So we're going to revisit this idea later, okay? Right now, I'm going to talk a lot about your SERA monthly pension. Later on, we will come back to the idea of Social Security and savings and investments, leading you to having that 70 to 80% income replacement in retirement. And then there's a question on the board, what's the difference between the tiers? The difference between the tiers is going to become evident in just a few minutes because the different tiers have slightly different ways, different rules around how we calculate the retirement allowance that you will be receiving when you retire. And so we're actually going to touch on that right now when we talk about some pension math. But there's a few there's a few differences between the tiers, and you'll see those pretty shortly. Okay, there's a question about health insurance benefits for retirees. I'm gonna hold on to that question. I do talk about that later on in the presentation. For right now, let me help you understand some pension math. Okay, this is maybe the only math that we're gonna do. Now, actually, we're gonna do one other thing, but this is pretty basic. It's just a multiplication, so it's pretty easy. And the reason I'm explaining this to you, even though this calculation is going to be done at the time of your retirement, which is probably some ways away, if you understand the three things that lead into your retirement allowance, it's going to help you plan for the future to maximize that retirement allowance. So it's good to understand these concepts, these three concepts. Okay. So this is the formula that we're going to calculate when you retire. And this is going to tell us what your retirement allowance is going to be for the rest of your life when you go to retire. What you will get in retirement is a percentage of your highest salary for each year of service. So this sentence is basically telling you in English what this multiplication is doing. When you retire, you're going to get a percentage of your highest salary for each year of service. Okay. Let me give you some numbers and it will help illustrate this better. Let's say that when you go to retire, the percentage of your highest salary that you are going to get for each year of your service is 2%. You're going to get 2% of your salary for each year of service. And let's say that you worked for 20 years full-time or the equivalent of 20 years full-time. So you earned 20 years of service credit with a SERA. Now, your retirement allowance is going to be, you are going to receive 2% of your highest salary for each one of these 20 years. So if you multiply them together, you'll see that 2% of your salary for each of the 20 years is 40% of your salary. Now let's put some more numbers in here. Let's say that your highest salary when you retire is $5,000. So we simply take your salary, multiply it by the 40%, and that would be $2,000 in this example, and that would become your retirement allowance for the rest of your life. So in this example, you're achieving 40% income replacement. And let me just answer this question that's up on the board because it's actually really quick. Are we able to continue our supplemental life insurance once we retire? You're not, unless the county says otherwise, but we don't offer any life insurance options. Okay, so the bottom line here on the pension math is that because this is a multiplication, the higher the age factor percentage, the higher the years of service, the higher the salary, the higher any of these numbers will equal a higher retirement allowance that you will receive every month for the rest of your life. So I will kind of help you understand how to maximize these three numbers. First of all, I'll talk about the age factor percentage, and let me help you figure out what percentage of your highest salary you will get for each year of service, or basically how we determine that. It's not something that you can necessarily know in advance. It's something that you can kind of guess at, but I'll tell you how we figure it out. The percentage of your highest salary that you're going to get for each year of service. So first of all, here is a sample age factor chart, and you'll see that we have all of Acera's tiers on here. So you're just going to look at your column, the column for your tier. So if you're in tier 4 and you're a general member, you're just looking at this column. Now, when you go to retire, we take your age of retirement and we find the percentage for that age in your tier column. So if you were to retire at age 62 and you were in tier 4, you would get the 2% of your salary for each year of service. Now, if you were to work another 3 years and retire at age 65, you would actually get 2.30% of your salary for each year of service. You could go all the way up to 2.5% of your salary for each year of service. So you can see that by getting older, this is how you increase the age factor percentage that we're going to use in the formula for you, because the numbers keep going up and up and up the older you are when you retire. You may also notice that there's a maximum age factor percentage for each one of the tiers, and that's denoted by the blue box. So if you retire older than the maximum age factor percentage, like if you're a general tier 2 member and you retire at age 66 or 67, you would get the 2.43%, which is the maximum for your tier. And then the other thing that you might notice is that I skipped a bunch of the ages because these percentages actually go up with every quarter year based on your birthday. So if your birthday is January 15th, for example, 1 quarter after your birthday is April 15th, 2 quarters is July 15th, 3 quarters is October 15th, and back to January 15th. And every time you pass one of those dates and get 1 quarter year older, there's actually a slight incremental increase in the age factor percentage. So there are actually more increases. And then if you ever want to see all of them, you can find those out on our website. If you go to acera.org/age, or you just search for it on our website, you can find all of those. But because your retirement may be a ways off, if you only remember one thing about the age factor percentages, this is kind of the bottom line of this concept, is that the older your retirement age, the higher the age factor percentage up to the maximum for your tier. So that's how the age factor percentages work. Okay, I talked about the age factor percentages in the formula, and let me tell you about the service credit and how to maximize that. Okay, quick question. Is highest monthly salary gross income or net? It's gross income. Okay, there's a question. I'm a mid-career employee considering leaving for another non-county job after 10 years. I use the Acera benefit estimator to see the difference in retirement income if I left now or at retirement in 30 years. Both calculations gave me the same average monthly salary. Why? because the benefit estimator on the website does not project increases in salary. Well, okay, really what it's used, here's how it works. Because you're doing a scenario where you're going to quit and go do something else, and then you're going to retire later, whatever your salary was at the time that you quit is what your retirement allowance is going to be based on. So that's what your salary is going to be kind of frozen in time. And it's going to be based on probably your last 3 years of work and an average of your last 3 years of work, which I'll talk about in just a minute. So your salary is going to be kind of frozen in time. And then, whenever you retire in the future, that's the salary that we're going to use. So that's why the salary projection doesn't change. And in fact, even if you weren't doing a scenario where you were stopping working and retiring later, you would still experience the same thing. So everyone is going to experience that because the salary estimator doesn't do projections of future pay increases. It basically takes your last pay period and it fills in all the pay periods it needs in the future to calculate your retirement benefit. And then it takes an average of that. Okay, let me tell you about the service credit in the formula. So I told you that you're earning credit toward retirement while you work. You start earning service credit on your first day of Acera membership, and you're going to earn service credit all the way until you retire, unless you stop working and then defer your retirement to a later date. And then really there would be another milestone here that would say termination date. And that's when you would stop earning service credit. But for those of you who are going to work straight into retirement, you're basically going to stop earning service credit on your last day of work. And then you would go straight into retirement. You earn service credit during your regular work hours. And you also earn service credit during your earned leave times. So earned vacation leave, sick leave, management leave, comp time, holidays, floating holidays. When you go out on those earned leave times, you are already earning service credit during that time and does not count against you for the purposes of calculating your Acera retirement. Now, there are some types of time that do not count for service credit where you do not earn service credit. If you're ever on leave without pay, you are not earning service credit while you're on leave without pay. If you purchase additional vacation, which some of our employers will allow you to do, you can purchase extra vacation on top of your earned vacation. When you go out on that purchased vacation and you mark that on your timesheet, during that purchased vacation time, you're not earning service credit toward retirement. That's the bad news. The good news is that it's not that big a deal. It's not going to make that much of a difference. If you take like a week here or there of purchased vacation throughout your entire career, I mean, it's going to be like, a 10 or 25 cent difference in your retirement allowance, which is like a wild guess, math wise, but it's going to be something minimal like that. So I wouldn't sweat it. Okay. Also, when you sell your vacation back to your employer, some of our employers will allow you to do that. So you're taking your earned vacation, and instead of going out on vacation, you're selling it back to your employer for cash. You don't earn service credit for that. Also, whenever you're out on overtime, whenever you're on, working overtime, or you're on call time, or you're on standby time, you don't earn service credit for those types of time. So, because this is a discussion of service credit and a discussion of how to maximize your service credit, because the higher that number is, the higher your retirement allowance will be, there are some types of time that you can purchase to increase the amount of service credit that we will put in the retirement formula for you. So this is a list of those, okay? The basic idea here is that there's this type of time that maybe you could have worked and earned service credit for that time, but the situation being what it was, the rules didn't allow you to earn service credit for that time. So later, you can actually buy that time They've decided that, that's allowable for you to buy that time to increase your amount of service credit. So the first category is listed here as ineligible and non-covered service purchase time. Basically, this is a really good example of what I was just talking about. For example, part-time work. If you started out working for your employer part-time, and I'm not talking about working for a temporary agency or working under contract, this is just plain old part-time, you were not an ACERA member yet until you got your full-time retirement eligible position. But then once you became an ACERA member, you can go back and buy that part-time work. And the same goes for all of the types of time listed here, which are all a little bit different takes on that same concept. TAP time is the county's temporary assignment pool. All of that time is purchasable once you become an ACERA member. Seasonal work, intermittent work, service as needed, project per diem work, those types of time that you are not in a full-time retirement eligible position. Once you become an ACERA member, you can buy that time. There's also the 2 weeks between your date of hire and your entry date. That's purchasable. If you ever go out on unpaid medical leave during your career, so let's say that you get sick, you go out on leave, maybe you burn through all your sick leave and vacation leave, and now you're out on unpaid medical leave. Well, once you return from that unpaid medical leave, you can buy that time, and you can buy up to a year's worth of time per instance of medical leave. So if you were out for a year, you came back, and then you went out for another year and came back, you could buy both of those 1-year periods of unpaid medical leave. Now, it's only for your own medical condition. And it's not for any family member's medical condition, because you can be out on what they call FMLA leave, which is the federal law that says that basically you can be on medical leave for a certain amount of time and you can't be fired. And you can be on FMLA leave for a family member sickness, but if that's the case, it won't count toward this unpaid medical leave for the purposes of making a service credit purchase. Okay. Similarly, we also have state disability insurance leave and military leave during your membership. So you can buy those once you return from those leaves. And then a question just popped up. What about workers' compensation? That is in the same category as state disability insurance leave. Often what happens is if you're totally out on workers' compensation and you're being paid from the workers' compensation system, and you're not being paid from your employer at all of that time is purchasable because you have not earned any service credit for it. Now, sometimes what happens is you're kind of half and half. You're being partially paid by the state disability insurance leave system or the workers' compensation system, and you're being partially paid by your employer. The part where you're partially being paid by your employer, that you are already earning service credit for. So the part where you're being paid by the state system and you have not earned service credit for that, that becomes purchasable. Now, you don't need to figure out how much of this time is. We'll figure it out for you once you submit the purchase request, and I'll tell you about that in just a minute. Let's see here. Yeah, I'll tell you about how to make the purchase in just 1 minute. Okay, so, and some of these questions that are popping up on the board, I'm going to get to those topics a little bit later. That's why I'm kind of skipping around. So I will answer all your questions. We have all of those topics coming up. There's these other two, redeposits of prior memberships and redeposits of community property. Okay, redeposit of a prior membership is you work for ACERA or you work for your employer. You are a member of ACERA, you earn a certain amount of service credit, you pay a certain amount into ACERA. You quit or leave employment. Upon leaving employment, you take a refund of those employee contributions that we are saving for you in your ACERA contribution account. That means that you are canceling your ACERA membership and you're losing all of your service credit, but you won't, because you want to take the money with you. Okay, then later you decide, I'm going to get another job with one of ACERA's 6 employers. You come back to work here, and then once you get in here, you remember how great ACERA's benefits are, and you think, I shouldn't have taken that withdrawal. Let me redeposit that money to get my service credit back, and you can do that. So that is called a redeposit of a prior membership, and you can get all your service credit back from a prior membership. Okay, now a redeposit of community property is when you are married or you have a state registered domestic partner. And California is a community property state, which means that if you're earning a retirement while you're married or in the state registered domestic partnership, the retirement that you're earning is considered community property, and it's one of the pieces of property that can be divided during that divorce or domestic partnership dissolution process. So if that happens and your ex-spouse or ex-partner takes part of your account, which means they would take part of your service credit and along with a part of your money, a part of your employee contribution account, if they take that part of that money and that service credit, and then they take a refund, so they are looking for cash, we will send you a letter in the mail telling you that they did that and give you an opportunity to redeposit that money, the equivalent amount of money, and you can get all your service credit back. That is a redeposit of community property. Okay, last category. Other California prior public service. So this is where you worked for another public agency in California at some point in the past. Some examples are given here. CalPERS, which is the state's pension system. You know, you worked for another county in California, you worked for the state, you worked for East Bay MUD, Port of Oakland, etc. And you are not eligible for a pension under their pension system. You can buy that time as a SERA service credit. So let's say you worked for East Bay MUD for a year. What you need to do is take a refund of your account over at East Bay MUD. And then once you have withdrawn from that pension system, you could buy that year's worth of time as a SERA service credit to increase the amount of service credit that we will calculate for, that we will put in the calculation for you when you retire. Okay, so I talked about what types of time are eligible for purchase. Let me tell you which times are not eligible, because we do get these questions often. I mentioned earlier that when you purchase vacation, extra vacation on top of your earned vacation, you don't earn service credit when you take the purchase vacation. You also cannot purchase that time as a service credit purchase. The time is just gone. But like I said earlier, it's going to be pennies, so don't sweat it. Second category, if you're out on leave without pay, but it's not medical, it's just plain old leave without pay, that's not purchasable. Third category, contract time or temporary agency time. Contracts, that time is not purchasable. Temporary agency, you were actually working for somebody else, so that's not purchasable. And then finally, if you have that other prior public service, this category that I was just showing you, and you still have money on deposit with that other system, you can't make the purchase with a SERA until you take a refund of your money from that other agency. Okay, so this goes to answer this next topic, subtopic of service credit purchases, goes to answer the question, how do I make the service credit purchase and how much is it gonna cost? Okay, first off, how much is it gonna cost? To make a service credit purchase, it will cost you whatever your employee contributions had been had you worked the time that you're trying to buy. So let's go back 2 slides. Let's say that you go out on unpaid medical leave for 6 months and you return from the unpaid medical leave and you want to buy that 6 months worth of time. Okay, you send us a purchase request. We do the calculation for you. And what we do is we will analyze how much you would have had to contribute in your employee with employee contributions had you been working for that 6 months. It's going to be an individual amount of money based on your salary and the percentage of your salary that you pay into a SERA's fund. And we will do that calculation for you. And those employee contributions that you would have made during that 6 months, that's what it's going to cost for you to make that purchase. Plus any interest that that money would have earned between then and now. So let's say that you get back from your 6 months of unpaid medical leave and you immediately make the purchase. Well, there wasn't any time for us to invest what that 6 months worth of money. So we wouldn't have earned any interest on it. So you're just going to pay the employee contributions. But let's say that you don't do that. Let's say you don't buy it immediately. let's say 3 years goes by. We post interest to all of our members' contribution accounts twice a year, the end of June, the end of December. So every time the end of June and end of December passes, that signifies that the money that you would have, the 6 months worth of employee contributions in this example, would have been invested and would have earned interest. So whatever interest that money would have earned between then and now, and in the example I'm giving you, you waited 3 years, so that's 6 individual periods of interest, you're going to have to pay that extra interest to make that service credit purchase. The bottom line here, you don't have to necessarily remember all of the nuts and bolts of this. Just remember that the longer you wait to purchase service credit, the more expensive it gets because of the interest. So that's the bottom line here. And how you actually make the service credit purchase is by completing our purchase redeposit request form. You can log into your account on our website to do that. I actually suggest going in, and I should change the slide. No, actually, no, go ahead and do that for now, because I don't think we've launched the purchase request form in DocuSign yet, but we will shortly. We're changing all of our forms over to DocuSign so you can do it all electronically. But there is, if you log into your account, there is a purchase redeposit request form, an electronic one in your account that you can fill out. You submit that. We will do the calculations to tell you how much the purchase is going to cost, and we'll send you a letter in the mail telling you how much it's going to cost. And then you can decide if you want to make the service credit purchase and how much of it you want to make. Going back to the list, for all of the types of time, except for the 2 redeposits, you could buy a portion of the time if you wanted to. If we told you it was going to cost a certain amount and it seems a little too expensive, you could buy like a portion of it. The redeposits are all or none. One more thing I'll say about the cost is that whenever you're purchasing these top bullet points up here on the list, you're only paying the employee contributions and interest. When you're purchasing the other California Prior Public Service, you're paying the employee and employer contributions. So this one usually costs triple of what the other ones cost. So that one can be kind of expensive. But when you get the letter in the mail saying how much it's going to cost, you can make the decision at that point. So you're under no obligation once you submit the purchase redeposit request to actually make the service credit purchase. And there's no way that you could, because you don't know how much it's going to cost yet until we tell you. And then once you decide to make the purchase, you have a bunch of different options. You can write us a check and make it on a post-tax basis. And you can purchase it in just one lump sum if you have some money laying around. Or if you have some retirement savings in one of these type of retirement savings accounts, pre-tax accounts, you could roll over money from one of those accounts and make the purchase on a pre-tax basis, such as a 401k, 403b, 457 IRA. Or we could split up the cost through payroll deductions over a series of pay periods. So if you're trying to buy 6 months worth of time, we could split up the payment that you need to make through, payroll deductions over that 6 months. And that would spread out the cost for you, or we can do any combination. So you got a lot of options. Okay, I often get, oh yeah, and that, I think that answers that question. Do you have to pay it all at once? You don't. So you could do it through payroll deductions. Okay, great. Oh yeah, and is the purchase amount pre-tax? It depends on how you do it. With a lump sum, check, post-tax, payroll deductions, post-tax. But if you do a rollover, it's pre-tax. Okay, and then the question that I often get, which you are asking, is it worth it? How do I figure out whether it's worth it to actually make the service credit purchase? Let me show you. And let me answer this other question real fast. It's up on the board. Is the retirement benefit taxable? Most of the retirement benefit is taxable because you're making your employee contributions on a pre-tax basis. Now, occasionally, if you make a service credit purchase, there will be some post-tax amount in there. You won't get double taxed in retirement because we'll keep track of any post-tax payments that you made. But most of it's going to be pre-tax, and you will owe income taxes on your retirement, lifetime retirement allowance. Okay, the question is it worth it? How do I figure that out? What you're going to do to figure this out, and you can figure this out on your own, is you go ahead and you submit that service credit purchase request, okay, in our website. You wait until we send you the letter in the mail telling you how much it's going to cost. Okay, then you log back into your account on our website, acera.org/WMS, or you can just go to our website, acera.org, press the login button. WMS stands for Web Member Services, which is the name of our portal, but nobody ever remembers that. So it's not important. Just go to acera.org and press the login button. Okay, once you get in there, there's a tool in there, and I'll show you some screenshots of this tool a little bit later, which is the Benefit Estimator tool. This helps you estimate what your lifetime retirement allowance is going to be in different scenarios for the future. Okay, so what you're going to do is you're going to go to the Benefit Estimator, and you're going to think of a plausible retirement scenario for yourself. You know, I'm going to retire in 20 years and you pick a date that's 20 years from now. So it doesn't have to be super accurate. The thing that you want to pay attention to is you're going to use the same retirement date for estimate 1 and estimate 2. Okay, you're going to make 2 estimates here. Now, once you get in the Benefit Estimator, you'll see that there is a service credit override field. Actually, let me see. I do have a screenshot here. Here's the Benefit Estimator. Okay, so you're doing a scenario. You're putting in a separation date and projected retirement date, which fits your plausible retirement scenario. Your separation date is your last day of work. Your projected retirement date is your first day of retirement. If you don't know if you're going to go straight into retirement or not, but it's plausible that you will, if you're going to just work straight into retirement, just pick 2 consecutive days here. They have to be at least 2 consecutive days. And once you hit calculate, it's going to project an amount of service credit for you. Okay. And then you'll see there's an override field here. So on the first estimate, you leave the override field blank and you hit get estimate. Okay. Do not override this amount of service credit. You hit get estimate. It will give you a PDF benefit estimate. Now you're going to do estimate number 2. You're going to use the same retirement date. So put the exact same dates in here. But in this time, you are going to override the amount of service credit. You're going to take the amount of service credit that you're trying to buy and you're going to add it to this number that it's already projecting. So for example, if you're trying to buy 6 months worth of time, that's 0.5 years. So you would add 0.5 to this number, put the new total in the override service credit field, and then you hit get estimate. Okay, so what's going to happen is you're going to see that estimate number 1 and estimate number 2 are going to give you 2 different retirement allowance estimates. Estimate number 2 is going to be greater because you have more service credit in estimate number 2. Okay, you look at these 2 PDFs side by side, and then you do a simple subtraction. You just find the difference between the 2 estimates that it's giving you. And the difference between the 2, this is how much more money that you would get if you make the service credit purchase on a monthly basis. So that PDF estimate is telling you what your retirement allowance is going to be every month for the rest of your life. So estimate number 2 is showing you how much more you would get once you subtract them, how much more you would get in the second scenario where you're actually making the service credit purchase. And then all you need to do is take the amount that we're telling you it's going to cost you to make the service credit purchase, and you just divide that number by the increase in your retirement allowance. And that tells you how many months it's going to take you to get that money back, because there's going to be some point in retirement where whatever money you put down while you were still working to make the service credit purchase, you're going to get that money back through increased retirement allowance, because your retirement allowance is going to be more than if you hadn't made the purchase. And you can decide if the number of months it takes to get that money back in retirement is worth it to you. Now, let's say that the service credit purchase cost is $1,000 and it makes your retirement allowance go up by $100. This is probably an implausible scenario, but just for the sake of it, let's just do it. Actually, let's say the purchase cost is $1,200 and it makes your monthly retirement allowance go up by $100. Well, that means it takes you only 1 year to get the amount of money that you made to make the purchase back in retirement. So that's a good deal. You're going to keep that higher retirement allowance every month for the rest of your life. Maybe when you do this calculation, it's going to take 5 years to get the money back. That's still pretty good. Maybe it's going to take 10 years in retirement or 15 or 20 to get the money back. Then you got to start weighing, is it worth it? So that's, it's all based on your own financial sensibilities and whether you think it's worth it. But that's how you can kind of do a few calculations to determine whether it's worth it or not. Okay, I told you a little bit about the age factor percentage. The older your age, the higher the percentage. I told you about the years of service credit. The longer you work, the more service credit you earn. If you purchase service credit, that will make your service credit number get even higher. One thing I failed to mention was that your service credit is measured in fractions of a week. So when you look at your service credit number in your online account, it'll say like, you have 4.78267 years of service credit. And that's us calculating your service credit down in the fraction of a week. Every 15 minutes you work, you're in 15 minutes of service credit. So you will get all of those fractions of a week and fractions of a day in the calculation for you. Okay, so I told you about the first two factors. Let me tell you about the salary. I saw some questions about the salary pop up. How do we calculate the salary? And how can you maximize the salary portion of it? Okay, so when we go to calculate your retirement, we are going to look at we have all your payroll records in our pension software. And the pension software is going to find your period of highest consecutive pay in your career. And that period of highest consecutive pay is known as your final compensation period. That's just some pension lingo that we use. If you're in tiers 1 and 3, your final compensation period is going to be your highest consecutive 26 biweekly or 12 months of pay, depending on whether you're paid biweekly or monthly. For tiers 2 and 4, which I bet the vast majority of you are in, your final compensation period is your highest consecutive 78 biweekly or 36 months of pay. So essentially, tiers 1 and 3, it's your highest year of pay. Tiers 2 and 4, it's your highest 3 years of pay. Now, our goal for the calculation is to find your highest average monthly salary over that final compensation period. So we do a simple average. We take the total amount of money you made during this period of highest pay. We divide it by the number of months in that period, and that gives us your highest average monthly salary. So if you're in tiers 2 and 4, we would divide your total pay you made over your 3 highest consecutive years by 36 months, and that would tell us your highest average monthly salary. Now, it's not based on a calendar year. It's not based on a fiscal year. It's not based on any of that. It's based on your consecutive highest pay periods, which for probably 90, 95, maybe even 99% of people would be like your last 3 years, because you're making your highest rate of pay at the end of your career. So for most of you, your final compensation period is going to be your date of retirement and then 3 years into the past if you're in tiers 2 and 4. And that's how that works. And that's full-time pay periods. Now, if you have any pay periods where you're working less than full-time, we will find other pay periods to smash onto to smash together to get to the equivalent of 78 biweekly pay periods. So 3 years worth of pay. So it's the 3 years worth of pay or the equivalent of 3 years worth of pay for tiers 2 and 4. Now, somebody asked earlier is it gross or net pay after deductions. It's gross pay, but there are only certain pay types that count toward this. Your base pay counts toward this, of course. And then there could be some other pay codes that you receive, other types of pay that could count toward this. And sometimes these are known as footnotes, but they're just other pay codes on your pay stub. I can't tell you off the top of my head whether your pay code counts or does not count, but you can figure it out for yourself by going to acera.org/paycodes, and then there will be a PDF there for your employer, and that has a list of pay codes. And it'll say, when you find your pay code on there, it'll say yes or no, whether it counts toward your retirement or not. If you need help finding your pay code, you can ask your payroll manager for more info. The one pay code that I know that never counts is overtime. Okay, There are two more types of time that can be counted in your salary for the purposes of calculating your retirement. If you're in tier 2, these bullet points would apply to you, not tiers 3 or 4. And if you sell vacation during that final compensation period, or if the final compensation period is at the end of your career and you cash out vacation, which means you still have some vacation left on the books and they will cash you out for it, some of that can count towards salary, toward calculating your retirement. And there are a lot of rules and ins and outs of that. I don't take a deep dive into that topic in this seminar, but if you do want to explore that topic, you can go look at one of our videos for our pre-retirement seminar. We probably have like a 20-minute discussion on this. And all you need to do is fast forward through the YouTube video till you see this slide, and then you can watch that discussion. Okay. Now for tier 4, one more thing I want to tell you about salary is that you have a salary cap of how much salary we are allowed to include for the purposes of calculating your retirement. This is one of the tier 4 rules that was written into the state law whenever the state created tier 4 in 2012. Tier 4 started on January 1st, 2013. So for general members, we are not allowed to include more than 140. If you were to retire in 2023, we would not be able to include more than $146,042 as salary on an annual basis for the purpose of calculating your highest average salary for retirement. For safety members for this year, it's $175,250. Now, when you get to retirement, which for new employees and mid-career employees is probably a ways off, these numbers go up every year. It's based on the federal government Social Security cap number. So by the time you get to retirement, these numbers will probably be a lot higher. But if you already do have a high salary that is higher than this, what we are doing each year is once you, and at the point in time in the year when you hit this salary cap and you start earning more salary than the cap, we stop collecting employee retirement contributions for Acera's fund from your check. So you'll see more money in your check. And so the bad news is that we can't include, more than the salary for this amount of salary for the purpose of calculating your retirement. The good news is it leaves you more money in your check to save in your 457B plan. So there are other options for saving more money. If you want more info about this, we have a whole page on this, acera.org/limits. Let me check the questions here. Okay, really quickly, I got a question. If you're in tier 2 and you're coming up on your and you're interested and you want to do the vacation sales or cash out to increase your retirement, your salary to increase your retirement allowance, if you go explore this topic in the pre-retirement seminar, you'll see that it's always better to max out the salary. So to actually get to sell the vacation or to cash out the vacation, mostly cash out the vacation. And it's like way better than getting the service credit for that vacation time. Okay, and then do the employer contributions also stop when the time limit is met? Good question. Let's see. I think they probably do. That's my educated guess on this. I think they probably do. The employer contributions, it's a little bit different than the employee contributions. Our actuary every year calculates how much we owe to our current and future members, like our current and future retirees. And so we basically have to collect now how much we owe now and in the future. So our actuary calculates that for us, and that's how they set up the employee contribution number. But then also the employer, unless we are 100% funded in our fund, which means we have for every dollar we owe now and in the future, we have $1 in the fund. That means we're 100% funded. the employee contribution and the employer contribution would be roughly equal. But because we're not 100% funded, the employer has to make extra payments in order to catch up over a 20-year period. So if you're actually able to see the employer contribution percentage, and you can look at that on our website, we have that out on our website, you'll see that it's much greater than your employee percentage because they're making those catch-up payments. The employer by law is on the hook for making whatever the difference is up. So they're going to keep making those extra payments until we get to 100% funding. I think we're maybe at about 80%, 86% funded. I can tell you real fast, probably because you're curious. Okay, this is our about page, and we are at 86.5% funded. We have $11.5 billion. So the employer will make higher contributions over time to make up that difference. Okay, there's another question. Will we get interest on our contributions after our annual caps out? You only get interest on the contributions that we have in your contribution account for you. So if you cap out and we're not taking more contributions over this amount, then you would not be earning interest on that. So that's how that works. Okay, and there's a few questions up on the board regarding what happens if you leave the county and retire working for another agency, and we will cover that a little bit later. Oh, and there was a question, is this only for tier 4 retirees? Yes. There are a couple of much higher caps for the other tiers, and you can find those at acera.org/limits, but they don't apply to most people because the salaries are super high. Okay. And there is another question about the age factor percentage. What will the age factor percentage be if I work 10 years as a general member and 10 years as a safety member? The way that works is we're going to do 2 of these calculations for you when you go to retire. So you will actually see, let's say that you do 10 years. In your example, you're doing 10 years in both. Okay. So in your calculation, we would take the age factor percentage for your age at retirement from the general tier and put it here, multiply it by the 10 years for the general work, multiply it by your highest salary. That gives us $1 amount. Then we're going to do a second one down here. We're going to take the age factor percentage from your safety tier for your age at retirement, multiply it by the 10 years you worked in your safety membership, and then multiply it by the highest salary. In both cases, the highest salary is the same number. And that's going to give us $1 amount. Then in retirement, we just simply add those $2 amounts together and send you one check. So in that case, you have a split tier. You actually belong to 2 different tiers, a general tier and a safety tier. Okay, and then I'll get to answer the questions about what happens when you move to a different employer in a little bit when we talk about career planning and reciprocity. Okay, for right now, let me show you the whole retirement allowance concept put together in an example. So this member is a tier 4 member. They retired at age 65 after earning 25 years of service credit. So based on them being in tier 4 and being at age 65 when they retire, that when we go to the age factor chart, we will find that those numbers intersect at 2.30%. So for them retiring at age 65, they will get 2.30% of their highest salary for each one of these 25 years of service. So all we do is we plug the 3 numbers. They have a salary of $6,000. They work for 25 years. We plug the 3 numbers in, multiply them together. That tells us their retirement allowance. Now, if you recall from the first math that I showed you, by multiplying the age factor percentage times the years of service, you can see what salary replacement percentage you're achieving. And I told you in the beginning of the presentation that you're going to need 70 to 80% salary replacement, which means that whatever you're making, whatever your working salary was, you will need to replace that with 70 to 80% retirement income in order to maintain your standard of living. This person is achieving 57.5% salary replacement, which is really good just from their pension alone, because there are going to be some other things, especially Social Security, will come in there and make up the rest, and then some additional savings. So this is really good. We'll talk more about that later. Let me show you, because I've been talking a lot about, in general, what your pension will be, what your retirement allowance will be. You can get your own pension estimate by logging into your account on our website. You can also look at our salary replacement charts. So let me show you two ways, really, to get an idea of what your retirement allowance is going to be in retirement. I'll show you this way first with these salary replacement charts. What you're going to do is you're going to go to our planning page out at acera.org. So you can type in acera.org/planning, or I will show you how to navigate to it. Okay, here's the home page of our website. All you need to do is go under members and go down to the third option, planning your future retirement income. Click on that. You go down to step 1, which is get an ACERA estimate. It shows you 4 ways that you can get an ACERA estimate. I'm showing you the first 2 in this presentation. And the first one is simply by using one of these income replacement charts. So what you're going to do is just click on the button for your tier. A lot of you are probably general tier 4 members, so I'll click on that one just to show you what this chart looks like. So this is a PDF. Let me zoom in here a little bit. And all you need to do is think of a plausible retirement scenario for you, and you just find that scenario on this chart. So you think, okay, I'm age 30 right now. What happens if I work for, let's say 25 years and retire at age 55? What percentage income replacement would I get? So you go to 25 years of service credit, come over to age 55, and you'll see that those intersect at 32.5% income replacement. Okay. Now you can kind of think of your current salary. You could take your current salary and multiply it by the 32.5%, and that would give you an idea of the dollar amount you can expect in retirement. Just like a rough ballpark percentage. That's why we call this kind of a ballpark salary chart. Now, one feature of this chart is what you can do is once you find that intersection, you can see the effect of working more or less years. And then you just go diagonally down the chart. So if I work one more year in this scenario, I will be age 56 and retire with 26 years of service credit. Well, that brings me up to 36.4% salary replacement. If I work another year, I go diagonally down one more, 40.5% income replacement. Then 44.8 to get to 50, almost 50% income replacement, I would have to work another 4 years. So in that scenario where I was retiring at age 55, if I wanted to get up to 50% income replacement, I would need to work another 4 years. That's how that works. Going back to the presentation, let me show you the second way to get a retirement benefit estimate. You go out to our website. This is a screenshot, and you press the login button. Once you log in, you will find the first screen that you will see is an account summary screen. If you've never logged into your account before, you will have to answer some security questions and create a username and password. Your username is your personal email address. Then you create a password. You put some answer some security questions, and then once you get in there, you'll find your pension data waiting for you. And you can see that it shows you a lot of stuff. It shows you your tier, your employer, whether you have reciprocity or not, your employment date, your entry date, how much service credit you've earned, how much you've contributed to the fund, so your balance of your contribution account. What you're going to do is you're going to click on the Estimate a Benefit tool, and that is going to take you to the benefit estimator. And I will zoom in here. All you do is you think of a retirement scenario that you could perhaps perhaps be a plausible retirement scenario for you. And you put in a couple of dates here. The separation date is your last day on payroll. Your projected retirement date is your first day of retirement. So if you think that you may work straight into retirement, you can just pick 2 consecutive days. If you think that I already see some questions up on the board about, going to work somewhere else, what happens to my retirement? Well, if you maintain your SERA membership by not taking a withdrawal when you leave, then you can become eligible for a retirement benefit later. And in your case, there would be a gap between these 2 dates. Maybe you're going to quit working in 5 years, so you put a date there, but then you won't be eligible to retire for another 10 years, or you don't want to retire for another 10 years, so you put that in here. Whatever the scenario is for you, you hit calculate, and it will do a service credit projection based on how much service credit you've already earned and how much you will earn in the future in this scenario. It will also give you a salary projection. And all you need to do is you can put beneficiary information here, and you could get estimate, and you end up with the SERA benefit estimate PDF. Now, we actually we redesigned this, and I haven't changed the slide yet. So it'll look something like this. It'll have this same, a similar table on it, your estimated monthly benefits, and it will show you the different benefits based on which option you choose. The option that you're going to choose, you're going to do that at retirement. You don't need to choose that ahead of time. Your life scenario is going to be different at retirement. So for right now, as a new employee or in your mid-career, you can simply look at the unmodified option, which is the top option. It pays the highest retirement allowance of any of the other benefits than any of the other options, and you just go by that one for now. Okay, and then there's a question. I'm tier 2, but if you look at the summary screen, it says tier 2A. Yeah, that tier 2A is the general member tier 2. For the safety members, there's tier 2B, tier 2C, and tier 2D that they might see based on which tier they're in. So yeah, as a general member, tier 2A, that is correct. Okay, so that is how you get a precision pension estimate based on the benefit estimator tool that we have for you in your account on our website. Moving on to the next topic, understanding your retirement eligibility, and we'll take a break after this topic. When can you actually retire? Well, you have to become eligible to retire. So we're talking about this milestone on the pension milestone chart. There's some combination of your years of service credit and your age at retirement. And this will actually answer the question up on the board, which is what's the minimum years of service you can have to receive a retirement allowance? So we will answer that question right now. Oh, and also the question, how long do I have to work for the county to receive these benefits? We'll answer both of those questions right now. If you're in tiers 1, 2, and 3, you're going to look at this slide. The tier 4 slide is next. And there are 3 different scenarios that get you to retirement eligibility. Okay. So you have 3 options here. Option 1 for tiers 1, 2, and 3 is that you have to be at least age 50. You have to have at least 5 years of service credit, and you have to have at least 10 years of membership with a SERA. Okay. If you're in one of these tiers, you probably have already earned at least 10 years of service credit. So you don't really have to worry about the difference between these two. This was for previous years when, people would earn at least 5 years of service credit, but then they would stop working. They would have to wait until at least 10, they have 10 years of membership. But if you're in tier 2, you've already been a member for 10 years at this point, because tier 2 stopped at the end of 2012. So just think of it as 10 years of service credit and be over age 50. That's option number 1. Option number 2 is, as a general member, you can have at least 30 years of service credit, or as a safety member, you can have at least 20 years of service credit and retire at any age, even if it's younger than age 50. Option number 3 is that you can retire at age 70 with any amount of service credit, even if it's less than the 5 years of service credit you would need under option number 1. So to answer your questions, in most cases, and even with tier 4, in most cases, you need at least 5 years of service credit, but they also have option number 2. So you could have less than 5 years of service credit and retire at age 70. But if you wanted to retire younger than age 70, which is, a little bit older than the average age that most people retire, I think it's maybe like 62. You would want to have at least 5 years of service credit. Okay, so then for tier 4, you have 2 options of achieving retirement eligibility. If as a general member, you have to be at least age 52. As a safety member, you have to be at least age 50, and you can retire with 5 years of service credit. So you don't actually need a ton of service credit to draw a lifetime pension from Acera. Now, of course, the more service credit you have, the higher your retirement allowance is going to be, the higher your pension benefit is going to be. So 5 years will be a very modest retirement allowance, but it would probably pay for a lot of your bills in retirement. And then like if you earn 5 years and then you go work somewhere else to do something, once you reach age 52, you could just go ahead and retire from Acera and start collecting that lifetime retirement allowance. And then again, you have option number 2 as a tier 4 member, and you can retire at age 70 with any amount of service credit. So if you do decide to leave before the 5 years, at age 70, you could draw a lifetime retirement allowance based on the 4 years that you earned with Acera, or the 3 years. And you can get a calculation of that in the benefit estimator to see what the dollar amount for that would be, to see whether you want to do that. So yeah, to answer the questions, the minimum years of service, if you're retiring younger than age 70, is 5 years. If you're retiring age 70 or older, it's any amount of service credit. Okay, quick question. Does that benefit estimator that I showed you a minute ago take into account that you have had a QDRO as a result of a divorce, and does it deduct the community property? Yes, it does. And so this topic is where I was telling you earlier, if you have a divorce and your ex-spouse takes part of your account, they basically take part of your contributions. So they take part of your money with them, and at the same time, they're taking part of your service credit with them, so that they can separately retire based on the service credit that they're taking with them. The benefit estimator does take that into account. And so when you look at the service credit, and in fact, I can go back. If you look at the summary screen before you click on estimate a benefit and the amount of service credit that you have in there, that should be the amount of service credit you have after your ex-spouse took part of your service credit with you, and the contributions should be the balance of your account after they took their part with them. And then whenever you do the estimator and it does the projected service credit, it is basing the projected service credit on what you have already in your account after they took their part. Okay, let me help you understand the additional benefits that we offer. Let's talk about the other benefits. And we're just going to talk about this very briefly. We talk about this at length in the pre-retirement webinar. But I just want to orient you right now to some of the additional benefits that we have. So In retirement, we offer medical, dental, vision, and other non-guaranteed benefits. There's also disability retirement as an option if you become permanently disabled and you can no longer perform your job duties. You can retire early under disability retirement, and that is also considered as an aspect of the guaranteed benefits. And there's also death benefits. So let me talk a little bit more about each one of those. What you're seeing here is a table of the different non-guaranteed benefits, also known as non-vested benefits. These are extra benefits that the county, sometime in the 80s, decided that the employees, the retired employees of the county, needed this extra set of benefits to be able to pay for their life in retirement, and they created a reserve fund at ACERA that pays for these benefits. It's called the Supplemental Retiree Benefits Reserve, and there's like $1 billion in there right now. And so these are extra benefits, so they're not guaranteed, and they are determined by our Board of Retirement at ACERA. And the Board of Retirement's job is to pay out these benefits, also determine what the benefits are, determine who gets them, and also ensure that funds stay sustainable so that the benefits are continue to be offered in the future, which is where the non-guaranteed part comes from. The board makes adjustments periodically to these benefits, how much they pay out, and so on and so forth to make sure the fund stays sustainable. But like I said, there's over $1 billion in there. The fund is currently more sustainable than it's ever been. So it's not really something to be too concerned about. Now, what I want to tell you about this right now is what the qualifications are to receive these benefits in retirement. The board has determined that it's based on years of ACERA service credit. You have to have a minimum amount for most of the benefits. For the supplemental cost of living adjustment, which is an extra cost of living adjustment on top of the vested cost of living adjustment, that one everyone has access to once, and what it does is protect your buying power in retirement. So you don't need any years of ACERA service credit to qualify for the supplemental cost of living adjustment. Now you can see that for the rest of them, they all start at 10 years. The medical subsidy, the MMA stands for monthly medical allowance, has 3 levels. The first one starts at 10 years. If you earn at least 15 years of ACERA service credit or at least 20 years of ACERA service credit, you get more of a medical subsidy. And then dental subsidy, vision subsidy, and Medicare subsidy to help you pay for the cost of being enrolled in Medicare. All of those start at 10 years. So that's kind of like the main thrust of what I want to tell you about the non-guaranteed benefits today, because this is a new employee mid-career webinar, and these benefits might look a little bit different by the time you get there. But the goal with ensuring the fund sustainability is that these are available to everyone, all the retirees, in perpetuity. But I just wanted to show you like these years of ACERA service credit to qualify, because I think that will help you plan out your career a little bit more. One thing that you may want to think about is that let's say that you've already been working here for 9 years, let's say 9.5 years, and you're thinking about leaving and you're thinking about going and doing something else with your life. Okay. You may want to consider sticking it out another 6 months in order to get over the 10-year mark, because this getting over the 10-year mark will represent a lot of additional money in retirement between the medical, dental, vision, and Medicare subsidy. That's going to be a lot of extra money, and this is on top of your retirement allowance. Okay, this is extra money that you get to pay for these. Now, if you left at the 9.5-year mark, you would not have any of that money available to you, which is why I like to actually put an additional milestone on the chart, which is the healthcare subsidies start at 10 years milestone. That's definitely something to think about. I mean, the same thing goes for if you've already worked, 14.5 years or 19.5 years, getting over the 15 or 20-year mark, that would get you more of a medical subsidy as well. So it's definitely something to consider when you're planning out your retirement. Now, for one thing I want to point out is this is years of ACERA service credit. So if you go work for another agency or reciprocal agency and you earn more service credit over there, but you have not yet achieved 10 years here, you would not be eligible for these. Or if you worked at a reciprocal agency before this, and then now you're working at your Acera employer, it's only the Acera portion that gets you to the qualifications to receive these additional benefits. There is a question up on the board. If I left the county and retire from another city county, can I still collect these health benefits? Yes, as long as you achieved the Acera service credit you need to qualify for the benefits. Like you work here for 10 years and a week. You quit, you go over work in Contra Costa County for 10 years. You retire. Because you got over the 10-year mark at Acera, then you would qualify for these benefits at Acera. And I think there was a question somebody asked toward the beginning of the presentation. Let me check that. Can health benefits be combined? So the question is, if you have reciprocity, and let's say that let's take that same scenario. You work here for over 10 years. You quit. You go over and work in Contra Costa County for 10 years, and you've linked the two systems together by establishing reciprocity. Can you combine the health benefits? If they offer healthcare benefits, let me see, it's possible that you could be enrolled in 2 medical plans, I think, and have double coverage. I think that's possible. I know that's possible with dental coverage. You can have 2 different dental plans. So you could have one from Acera and one from them. And so you could get a higher level of dental coverage, and it's probably, I think that's possible for vision coverage as well. Now, once you get to Medicare age, you can't be enrolled in 2 different Medicare supplemental plans. So you couldn't do that with Medicare, but I think with medical you can. You would want to at the time of retirement, you would want to check with Acera staff to make sure that is, I'm telling you the right thing, but I think that's possible. And then the question, can retirees choose which one to use? Yeah, you can. It's your choice on whether you want to enroll in our medical coverage or not at the time of retirement. And we'll tell you more about that when retirement comes up. And yeah, and there's another question up there about subsidy. By subsidy, are you saying it's an addition to the calculated monthly pension? Yes. So if you want to learn more about these, you can go to acera.org/guide, which is our annual enrollment guide for all of our healthcare plans. If you want to learn more about all the healthcare plans, this is a PDF, and this has all the info of what our plans offer. It's taking a while to load, but I will go ahead and type that link in there for you. acera.org/guide. And then you can see what the different subsidy amounts cover. Okay, so yeah. So this is a whole 36-page guide. There's a question, if I leave this position and they also have an ERA, will it continue? Can you tell me what an ERA is? I'm not familiar with that term. What is that, like earned run average in baseball? Let's see. Okay, I think what you're saying is if you leave this position, you go to another employer and they also have a pension system, how does that pension system relate to Acera? Is that the question? And feel free to type that in. If that's the question, that is the topic of. Oh, okay. Let's see. Okay, so let me talk about that when we talk about reciprocity. So we'll get to that topic in just a few minutes. Before I get there, while we're still on the topic of additional benefits, let me tell you about our death benefits. So this is the topic of designating your beneficiary or beneficiaries and keeping them current. Your beneficiary, that word simply means someone who gets benefits. So your ACERA beneficiary is someone who you designate to get your ACERA death benefits after you pass away. Now, in this presentation, what I'm going to show you is the set of death benefits that would be available to your beneficiaries should you die before retirement. Once you retire, there's an entirely different set of death benefits that your beneficiaries would be eligible for. And we talk about that in the pre-retirement webinar. So if you want to see the discussion of that, you could go to the pre-retirement webinar. Because this is the new employee mid-career webinar, I'm going to tell you what happens should you die before retirement. Okay, if you are not yet a vested member, which means that you do not yet have 5 years of service credit with ACERA or combined between ACERA and a reciprocal agency, what your beneficiary or beneficiaries would receive is basically a return of the balance of your ACERA contribution account. So that's all the employee contributions you paid into ACERA plus the interest that we've posted to your account. We would give them that entire balance of that account back, plus they would get 1 month of salary for each year of service that you have already served, up to 6 months worth of salary. So let's say that you die after you've worked for 4 years, you've earned 4 years of ACERA service credit. They would get 4 months worth of your salary in addition to the balance of your contribution account. Okay. If you're vested, on the other hand, you have at least 5 years of ACERA service credit, they get more options. That first option, option number 1, is still available to them. Okay, and they're going to be choosing this option. You're not designating the option ahead of time. So we offer them these 3 options. So the option number 1 is the return of the contribution account balance plus the 1 month of salary for each year of service up to 6 months. Alternatively, they could pick option 2 if they are your spouse, state registered domestic partner, or your Alameda County domestic partner. They could get a monthly survivor's allowance. Now, if they're your spouse or domestic partner, they could get a lifetime retirement allowance. If they are your minor children, so did I include them? Spouse, state registered domestic partner, Alameda County domestic partner, minor children. Those are all the qualified beneficiaries. If they are your minor children, they could get a monthly survivor's allowance, but it would cut off at age 18. And I think it can continue until age 22 as long as they maintain an enrollment in an accredited school, at which point it would cut off. So for the minor children, it's not a lifetime allowance. Okay, option number 3, the same set of qualified beneficiaries, is kind of a hybrid of options 1 and 2. There's a lump sum that they would get, which is 1 month salary for each year of service up to 6 months, plus a smaller monthly survivor's allowance. And at the time that they are making this choice, we send them a letter that shows them the dollar amounts of all of these different options so that they can make an informed choice. Okay, now those 2 slides were if you should die as an active member. I'm not saying that you're dying at work. I'm just saying that you die while you're actively employed with your employer, with your ACERA participating employer. Should you terminate your employment but maintain your ACERA membership and not retire yet, which is what we call becoming a deferred member. You're not an active member, you're not actively paying into the system. You're not a retired member, you haven't retired yet. You're in between. You stopped working, but you haven't retired yet. That's what we call a deferred member. You've stopped working and deferred your retirement to a later date. So if you should die as a deferred member, the only option would be a return of the employee contributions and interest to your beneficiaries. Okay, for more information on the death benefits, there are a lot more details on this. You can go to our death benefits page at acera.org/death. And one more thing that I want to point out about this topic is that you should keep your beneficiary designations current, okay? As an active member or even a deferred member, if you have not yet retired yet, you can change your beneficiary designations at any time. You can redesignate new beneficiaries anytime you want. You could redesignate a different beneficiary every day if you wanted to, simply by filling out our beneficiary designation form on our forms page at acera.org/forms. Now, to check who you have currently designated as your beneficiary, you can log into your account on our website by going to acera.org and pressing the login button. Once you get in there, you will see this nominated beneficiary selection. You can click it and you will find on the nominated beneficiary page who you have currently designated as your beneficiary. Now, if you should die today, whoever is on that page, that's who we pay out. So if you get in there and you see that you have designated your spouse from 3 spouses ago, you're going to want to go ahead and redesignate your beneficiary. And there's actually links in here to the forms that will take you out to the forms that you need to fill out. So go ahead, just like make sure you keep your beneficiary designations current. And then there was a question in here. What about dependent children? I guess, and you have in parentheses disabled, I guess that means they're adult children, but they're dependent. They do not qualify as a qualified beneficiary for receiving a continuance for the active death benefits. So they would only have option number 1, which would be a return of the contributions and interest and the 1 month of salary for each year of service. Okay, and there was a second question about that as well. Adult children, yeah. So yeah, I'm not sure why the law is written that way, but that's the way the law is written. The qualified beneficiaries are only spouse, state registered domestic partner, Alameda County domestic partner, and minor children. There's a question up on the board. Where do we find this presentation? Sorry, I didn't say that already. All you need to do is go out to our seminars page, which I'm already on, but you go under news and events, go down to retirement planning seminars, and then it's on this page. If you go under webinar options, you open the accordion for new employee mid-career webinar, it's right here. It's a PDF. Okay. Going back to the presentation. Let's talk about career planning options. And when I say career planning options, what I mean is maintaining your career, whether you're going to continue working here, whether you're going to work here straight into retirement, whether you're going to go work somewhere else. What are your different options for this? And there's a lot of questions up on the board about this, like about reciprocity or what happens if I go to a different employer. So let me tell you all about that. Oh, and there was a question up from earlier for the continuance beneficiary after death. If the beneficiary is a minor, would they have to wait until 18 to receive payments? Interesting question. There is... Let me take that question. Let me just type my email address in here. If you can send me an email, I can answer that question because I need to go research that. So I'm not sure what the answer to that question is because I think there's a way that you can designate a minor for beneficiaries as by designating a guardian to receive the payments to give to the minor. And I think we're in the process actually of updating our beneficiary forms to make those instructions more clear. So go ahead and send me an email and I can clarify that. Okay, so regarding career planning options, what I'm going to show you is two options and kind of 3 sub options of the second option. Okay, the first option that you have regarding your career is at some point you're going to stop working, and your first option is always, if you're eligible to retire, you can just retire. okay, from Acera. So if you meet the eligibility requirements, you are tier 4, you're over age 52 as a general member, you already have 5 years of service credit, you could just go ahead and retire. Okay, so that's always an option. If you're going to retire, you're going to keep earning service credit right up to your retirement. We will convert your sick leave on a 2-to-1 basis up to a cap to service credit. You can even go work somewhere else if you want. So you can retire from Acera. Let's say that you are age 52. You retire from Acera, you still have some working years left in you. You go work wherever else you want to. We're going to consider you an Acera retiree. We're going to pay you that lifetime monthly retirement allowance, starting at the time of your Acera retirement, even if you are fairly young, like age 52 or 53. Okay, so that's option number 1, is to retire. Option number 2 is, what if you're not ready to retire yet? What if you're going to terminate before you retire, which means that you stop working, but you're not going to retire quite yet? What are your options? Well, I'm going to show you 3 sub options for this. We're going to label them A, B, and C. Okay. And the idea here is that just to add another milestone to the pension milestones chart, you're not going to work straight into retirement. You're going to leave, and then your retirement is going to be some later date probably. Okay. This is your termination date. This is your last day on payroll with your current employer. What are your options? So I'm going to show you options A, B, and C. Okay. Option A, you can defer your membership, which means that you become a deferred member with Acera. I already defined that earlier. You're not an active member anymore, but you haven't retired yet. And as a deferred member, the word member is in there, so you're still an Acera member. And as an Acera member, that means that you still have your contributions in your contribution account with Acera. Interest will continue to accumulate. We are still going to keep your money invested, and we will still keep paying interest to your account. In fact, there's no negative interest. And people ask me what I mean negative interest. If Acera loses money in a particular 6-month period, like we did because the markets tanked at the end of 2022, we don't go into your account and go, okay, we earned negative 11%, so we reduced the balance of your account by 11%. No, we never do that. We never take money out of your account if we lose money in the short term. Over the long term, we earn lots and lots of money, but in the short term, we never post negative interest. There's no risk to leaving your money with Acera. It's actually an amazing place to keep your money parked. With the amount of interest that we tend to earn over long periods of time, and if you go to our contribution page, acera.org/contributions, actually, I'll show you how to navigate to that. You go under members. You go under understanding your Acera benefits. You can scroll down here, contributions and rates, or it's over in the menu too, contributions and rates. This shows you how much you're paying into Acera. This also has a section on your contribution account, and there's a little accordion here, how much interest does Acera post to my contribution account, and you can see all the historical rates of interest. You can see that this far column kind of gives you an idea of how much interest we earn per year. It hovers in the 7 to 8% range. There's nowhere else you can park your money that has zero risk that you earn that kind of money on your money. So it's a really good thing to be able to keep your money parked with Acera and be a deferred member. You can even retire later out of deferred membership. Some people will stop working. They will not be eligible to retire yet, but they'll go do something else. And then once they hit that age 50 or 52, whatever it is, you can just go ahead and retire out of deferred membership and start collecting your retirement allowance. Or as a deferred member, since you're still an Acera member, you're on hold. If you decide later, you go work somewhere else, you come back to work for one of Acera's participating employers, you can pick up where you left off and earn more credit toward retirement. Or you can be refunded at any time. So I'm just going to show you options A, B, and C. Option C is to take a refund of your contribution account. You don't have to do that immediately. So if you don't know what you're doing when you stop working, you don't want to make a decision yet, you just become a deferred member and you can make a decision later. You can retire later, you can take a refund later. Okay, that's option A. Option B is establishing reciprocity with a different retirement system in California. So I've mentioned this a number of times because it seems like a lot of you or a number of you either have reciprocity or are interested in this topic, maybe establishing reciprocity by going to work for a different public agency in California. So let me tell you all about that. When you establish reciprocity, what you are going to do is you're basically going to take option A. You're going to become a deferred member at Acera, okay? And then you're going to also take option B, establish reciprocity, which means, excuse me, you're going to go get a job for another California public retirement system, like another city in California. So we have reciprocity with many of the cities in California, or maybe you go work for the state. So we have reciprocity with the state or any agency in California that uses CalPERS, which is the state's pension system, as their pension system, because a lot of agencies are so small that they don't have their own pension system like we do in Alameda County. So, and also on the list should be every other county in California. I should add that to the list. The full list, you can go to acera.org/reciprocity to find the full list. Somebody was asking, what happens if I go to another county and they have their pension system is not going to be named Acera because Alameda County Employees Retirement Association is Acera, but it'll be something era, like you were talking about, like Contra Costa County is CC Sarah, or I think that's how they pronounce it, or let me see, what's another one? San Diego County is SD Sarah. So we have reciprocity with all of those as well. And what happens is you go over to that, you go work for one of their, you work for that county or one of the agencies that uses their system in the county, and you establish reciprocity and link their pension system with Acera. And the benefits of doing that, there are three. First benefit is that service credit you earn in all the systems combined gets you over the vesting and retirement eligibility requirements for the vested benefits and for retirement eligibility. So for example, you're a tier 4 member, you work for 3 years at Acera, you quit, you go work you get a job in Contra Costa County, you work there for 2 years, that's 5 years combined. And let's say that you're age 52, you can retire from both systems with that 5 years combined. Now, if you didn't have reciprocity, you'd have 3 years in one and 2 years in the other, and that would not get you to that retirement eligibility requirement at age 50. The second benefit of reciprocity is that the highest salary you earn under any of the systems you have linked together will be used by all the systems when they go to calculate your retirement. So let's say that you are working at Acera and you're earning $20 an hour. You're working for an Acera employer. Okay, you find another job working in Contra Costa County for $30 an hour. Okay, let's say you worked here for 5 years. You go over there and work for 5 years. Then you find another job working for, let's say, Marin County for $40 an hour. You go work over there for 5 years and then you retire. Well, each of us is going to do a retirement calculation separately based on the 5 years that you earned under each system. But we're all going to use the highest salary that you earned under any of the systems. So we'll use your salary from Marin County in this example. And what this is doing is making it so that you're not starting over from scratch whenever you go to a new system. You're basically getting to multiply your highest salary by that entire 15 years in essence. But we're doing 3 separate calculations. We're sending you 3 separate checks, one from each system, because we're all separate systems. Okay, the third benefit of establishing reciprocity is if you are in tiers 1, 2, or 3, it will keep your contribution rate lower in the new system that you move to. If you're in tier 4, And that's because people pay variable rates based on their age when they enter the system. Tiers 1, 2, and 3. Tier 4, it's not like that. Everyone pays the same rate. So tier 4 members, you don't even have to think about that. Okay, now to qualify for reciprocity, you got to do a few different things. The first is that you have to leave your contributions on deposit with each one of the systems you're linking together. So you're not taking a refund of your contributions. Number two, it has to be no more than a 180-day gap, which is a 6-month gap between terminating between the termination date from here and when you enter into the next retirement system. I think we adjusted this. You don't have to enter into the next retirement system. You just have to be hired into the next job. But it's no more than a 6-month gap. So I should update this slide. And then this is also updated. You cannot have more than 12 weeks of overlapping service. Okay. We used to say no overlapping service. Now you can have no more than 12 weeks of overlapping service. So if that's like if you're on paid leave here at the end of your career here, like you're on vacation leave, you're using up your vacation, and then you go start the other job immediately, that's overlapping service. You don't want to have more than 12 weeks of overlapping service. Also, you have to retire from all the systems on the same day. And then, that's just a requirement. So as long as you do these 4 things, you can establish reciprocity and receive the benefits of reciprocity. Okay, so let's see. There's a question up on the board. If you have a number of years and an age to collect your ACERA pension, can you deny reciprocity and go work for Contra Costa County and double dip? Okay, so what you're saying is that you're already eligible to retire from ACERA, okay? And you find another job over in Contra Costa County, and you decide you're already, did I already say you're eligible to retire? You're already eligible to retire from ACERA. You can go ahead and retire from ACERA. That's your option. You don't have to establish reciprocity. So you can retire from ACERA, start drawing your ACERA pension, and then you go over and start working your job from Contra Costa County. And it's really not even considered double dipping because you're not working for the same employer. You're just going over to a new system and earning an entirely new retirement from scratch. Now, what you're going to have to think about is you're probably going to have to work over there for at least 5 years to be eligible for, benefits over there as well. If you establish reciprocity, you may not have to do that. Let me see. There was a couple of other questions about reciprocity up here. How did the calculations work when we move to another county and retire at age 65? So it works kind of like I'm saying. If you go work for another county and you link them together with reciprocity, and you retired at age 65, then both systems would do a calculation based on the service that you earned in each system. And then we would each send you a check. So if you worked here for 20 years and you go work in, let's say San Francisco County for 5 years, we would do our calculation based on the 20 years you worked here. They would do their calculation based on the 5 years you worked over there. We would each use the age factor percentage from your tier in each system. So that would not be shared. The only thing that would be shared between the 2 calculations is your salary. And then the last question up here. What would happen with my retirement that I have with ACERA if I leave the county and I'm retired and I work for another company? So if you go work for a private employer and you retire from ACERA, we don't care. You're gonna be an ACERA retiree. We're gonna pay you your retirement allowance every month for the rest of your life. You go work for whoever you want. Okay. So last option number C, option letter C, is taking a refund of your employee contributions and interest. Okay, you can do this. You stop working for your employer and you tell ACERA, I want a refund of my contribution account. You can do that. That's your option. It's your money. If you take a lump sum payment, you may lose 1/3 of your money to taxes and penalties. If you're taking this lump sum early, I don't know. I don't remember what the cutoff age is. It might be younger than age 59. You would owe penalties for early withdrawal from our retirement system. Plus, we would have to withhold income taxes, and all that added up would be about a third of your money that you would lose immediately. Unless you roll over your money into another pre-tax account, there are some examples here, then we would not withhold taxes, and you would not owe penalties. But refunds can take some time. They can take over 60 days. And basically what you're saying when you terminate your membership and you take a refund is you are not an Acera member anymore. You don't want to collect the retirement allowance. You don't want to have access to the healthcare benefits or the death benefits. You're basically saying, cancel my Acera membership. Just please refund me my money. So that is up to you. But let me just give you a little pitch for not doing that, because if you are already eligible to retire when you stop working and you're considering whether to take a refund or the retirement allowance, I told you at the beginning of the presentation that in the first 3 to 5 years of retirement, we're going to give you the balance of your contribution account and interest anyway. And then everything after that first 3 to 5 years is just like a pure bonus for you, which you would not get if you took a refund. Additionally, if maybe you're younger and you're thinking, well, I'll just take a refund and I can go invest my money somewhere to try to earn a lot of interest on that money. Well, going back to option A, if you recall, you're still going to earn interest on your money with the Acera, and there's no risk. So I highly doubt you can find somewhere that earns 7 or 8% per year where there's no risk. So I just think in most cases, it's beneficial for you to leave your money on deposit with Acera. But like I said, it's up to you. So that's my little pitch for not taking option C. Okay, so last topic, making a retirement planning picture. And I'm going to cover this a little bit quickly because we need to move on to the deferred compensation discussion pretty soon. But let me just show you how to achieve the income replacement that you need to maintain your standard of living in retirement. Okay, you've already seen this slide. This is a picture of your future income in retirement. Okay, we have your Acera monthly pension here. We also have Social Security income. Anything that you need on top of your pension, Social Security income is going to come from your savings and investments, your personal savings and investments that you make starting now. And these should all add up to 70 to 80% of your working salary. Now, Gene Hilliard, who is our deferred compensation representative, is going to talk to you about trying to get you to 100% income replacement through the 457B plan, which is very achievable. And there are many, many examples of county employees who have been able to do that. Okay. But what I want to do is just get you pointed in this direction. Okay. So it can sound onerous to, maybe save up 70 to 80%, or that whole concept might sound onerous, but all I want to do is get you pointed in that direction now. Okay. But to know whether you're pointed in that direction, you're going to have to do a few calculations. So the first step is to get some estimates. So you get that Acera estimate like I showed you. You go to the benefit estimator, you log in your account, you get the benefit estimator, you do a retirement scenario, and you get an estimate from Acera. You're also going to want to do that on the Social Security website. Okay. So here's the Acera login. You go estimate a benefit, you end up with the Acera benefit estimate PDF. You get that number. And also take note of your age, okay? That you're, for your retirement scenario. In this example, this person's estimate is over $2,200 per month, and they're retiring at age 62. Okay, you're going to want to get a Social Security estimate as well. You go out to Social Security's website, ssa.gov. If you just go straight there, there's probably a link to their estimator, or you can go to this address right here, ssa.gov/estimator. they're going to take you through a similar process. You're logging into your personal account on the Social Security website, and they're doing future projections for you based on what they know about your work history. You will end up with an estimate page that looks something like this. They'll show you 3 different retirement ages and 3 different amounts that the Social Security system will pay you should you start collecting Social Security at those 3 ages. So for this example, we're just going to focus on age 62, and they're saying they're going to pay you $1,700 per month at age 62 should you start taking Social Security then. Now, what I suggest to fill in that last portion of the equation, this one right here, I don't think you need to sit down and do this by hand. You should use technology. There's all these there's all these retirement estimators out online that you can use to try to see if there's a gap here and whether you need to fill it in and how much you need to fill it in by. Okay, so let me show you one of those. There's some listed out here. If you just search for retirement calculator in Google, there's like 30 of them that come up. I suggest using ones that are listed out here that will allow you to put in a pension amount and a Social Security amount. I'll show you the Vanguard calculator here. This is a screenshot from it. And let me just make sure that this Vanguard calculator is still working like this. Okay. So and rather than doing screenshots, I'm just going to go right out to do it live on the website, just to give you an example of how to do this. And so what I'm doing here is I'm going to Acera's page, acera.org, going under members, going down to planning your future retirement income. And this whole article is a longer version of what I'm walking you through here in the presentation. And it'll take you step by step, getting an Acera estimate, getting a Social Security estimate. There's links out to all this stuff. And then calculating how much additional to save. And there's even links out to the calculators. So I'm going to click on the Vanguard calculator just to do one example. And what I'm going to do here is plug in a retirement scenario. So let's say that I'm 30 years old. Let's stick with that. I want to see if I can retire at age 62 example. And let's say that I make, let's say 65,000 a year. Okay. And this field right here is asking for how much of my income I save annually. Let's say I currently save 0% annually. I don't save anything annually. That's fine. We'll just start off from there. We'll start from 0. And let's say I've already saved 0. I mean, if you already have some retirement savings, you could put that in here, or you could just leave it at 0 if you have not saved anything. It's totally fine. Don't stress out about that. Okay, you have time. You're a new employee or you're in your mid-career. Okay, now this is the income replacement number that you're trying to achieve. Okay, so financial planners will say you need 70 to 80% income replacement. Let's just do 80. Let's see what happens. Or you could do 100, like Gene Hilliard is going to try to walk you through in just a minute. This number right here is the annual expected return on this additional savings that you're going to make. And so the idea here is that we're going to calculate an amount of additional savings to get you pointed in the trajectory of having 70 to 80% income replacement. In this scenario, we're going to do 80% income replacement. And the idea is that you're going to take this extra savings and you're going to invest it somewhere that can earn interest. Now, this number should be somewhere probably between 2 and 7%. You can find really safe places to earn 2% on your money. And actually with interest amounts right now, you can find places where you put your money in a savings account, a high interest savings account, and you can earn like 3.5%. Just having it in a safe savings account, FDIC insured. Discover Bank is one of those. And if you ever want to search high interest savings accounts, just type that into Google and type in NerdWallet, and it'll show you what all the current ones are and what all the percentage rates are currently. But If you want to earn a little bit more money, you can invest your money in somewhere like the 457B plan. And over long periods of time, based on looking at the past 100 years, over long periods of time, you can earn more than that smaller amount. You could probably earn 6, 7, 8% over long periods of time. Okay, so I'm just gonna do it like a conservative 6%. So I'm gonna park my money somewhere that earns 6% on average in a diversified basket of investments. And if you put your money in the 457B plan, they will help you totally diversify your investments. Okay, now with this calculator, what I'm going to do is put in that Social Security estimate, which was about 1,700. We'll just do round numbers. And then my monthly pension from Acera was about 2,200. Okay, now I'm going to hit calculate. And it's going to give me this chart. What the green bars are representing is my estimated monthly income in retirement just based on my pension benefit, which is the lighter green, my Social Security, which is the darker green. Over here, this bar is representing how much money I'm going to need. So there's a gap here between my pension and my Social Security. I'm not going to have enough to have that 80% income replacement. I'm going to need to save additionally, and I should probably start now saving it. And so this calculator is going to help me figure out how much additional to save. So let's see. Let's say that I save $500 of my annual income. I'm going to hit recalculate and see what difference that makes. Not much of a difference. Okay, let's see what happens if I save $5,000 of my annual income and hit recalculate. Oh, I way overshot it. Okay. Let's go down to 2,500 of my annual income. The idea is that you want to get these bars kind of even. So for 343, 333. So those are about even. So what this is telling me is that in this scenario where I'm 30 years old and I'm going to try to retire at age 62, and this is my current salary, if I'm going to achieve 80% income replacement, I will need to save an additional $2,500 out of my annual income in order to achieve by the time I retire that 80% income replacement. Now that might sound like a lot, but if you divide it up over 26 pay periods throughout the year, $96 a pay period. So that actually isn't a giant amount in this scenario. But maybe you don't have $96. Maybe you have $20. Well, you just start there. Start with $20. And then I think that you'll find that whatever you're saving, you won't miss it. And maybe you can adjust it over time. And the kind of the bottom line here that I'm trying to impart to you is illustrated in this chart. You get pointed in a direction with additional savings, and the calculator will help you get pointed in a direction. You come back a year later or 6 months later, when like periodically, you do the calculator again. It'll point you in a slightly different direction. You come back a year later, do the calculator again. Just make sure that periodically you come back and you readjust the additional savings based on your new numbers. And what you will find over a long period of time, over the 10, 15, 20, 25, 30 years between now and your retirement, is that by the time you get there, if you start now, you will have achieved the income replacement that you're looking for just by getting pointed in that direction now. And you can do it, you can start with as little as $20 or $30 per pay period to just get pointed in a direction. There's some more slides here on earning interest. I will let you go through these slides on your own. Maybe I'll just touch on them because I want to turn it over to the county's deferred compensation program here shortly. This is just talking about, the power of putting your money where you can earn interest by beating inflation and earning more through compound interest. This just gives you an illustration of how with compound interest, you earn a little money, then you earn money on your money, then you earn money on the money that you earned on your money. And so compound interest accelerates your earnings over long periods of time by leaving your money invested. This is just talking about being cautious with where you park your money. There, if you invest in some place that is a valid place to invest your money, like the 457B plan, and you talk to Gene Hilliard, you can make an appointment with him. He'll tell you all about that. And he will actually help you do some of these calculations. Like he can sit down with you and do some of these calculators for you and tell you how much additional you might want to save. Then and help you mitigate risk. Generally, over long periods of time, the risk is fairly low if you leave your money invested in like legitimate places, like in divert, and you spread your money out over a diverse basket of investments. In the 457B plan, while you do that, you don't have to be an investment expert. There's like a few options to pick from. There's a computer program that helps you do it. He'll tell you all about that. But I guess kind of what I'm trying to say is you are in charge of your own financial risk. So just, do your own research about where you want to park your money. If there's some guy that your dirtbag cousin is telling you, he earns 10% guaranteed, or he tends to earn 10% over time, that's probably a scam. I don't, research everything on the internet. Even watch that documentary on what was it, Bernie Madoff. People thought he was totally legitimate, and he was like this manager that was taking everyone's money and investing it, and it was a Ponzi scheme. So, do your own research. NerdWallet, Investopedia are great resources to show you legitimate places you can put your money, and especially the 457B plan is a great place. They will help you learn, find places that are legitimate, that you can earn interest and park your money in a very risk-adjusted place. Sorry, I'm kind of hurrying through this part of it, but I do want to turn it over to Gene Hilliard because he's actually the financial expert, and he'll tell you all about this topic. But there is an expanded article at acera.org/planning that walks you through this step by step. Okay, at this point, Gene, are you there? And I think you're muted.
There we go. Got it. Hey, Mike, how's it going?
Good. How are you?
Good, good. Let me, can I go ahead and hit my, let's see. Well, hold on. My presentation disappeared. Hold on. Let's see. Here we go. There it is. Bear with me here. Let's see.
Sure. No worries.
All right. Somehow. Can you see my notes on this presentation?
No.
Hold on. Let me do something else. Let's see.
Are you it looks like you're running it off a PDF. Yeah. Nope. We don't see your notes. We do see the slides over on the left side, and if you hit the hamburger, the three lines, yeah, that one, it'll
Thank you. That was a, oh, I see what happened. This is, I don't actually have that's a PDF. Hold on one
Yeah,
second.
that's a PDF.
Let me actually get the presentation.
Okay. No worries.
All right. Desktop. No, we're gonna go here. Should have been a little more prepared, but it happens. How's that, Mike?
Looks like you're still sharing your browser. Are you trying to share PowerPoint?
Yeah. Let me do this. Let me stop there. Share again.
There we go. And we're seeing your
There we
notes.
go. There we go. Got it. All right, guys. Thanks
And
so
your
much
your
for your
notes are up
patience.
there.
Well, good afternoon or good morning. My
Hey,
name is
Gene.
Gene Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company here in Oakland. You know what? I want to put on my video while I'm at it. Let's see.
Sure. And I just wanted to mention we can see your notes.
Oh, thank you. Still can see them?
Yeah, I can see. Yeah, still can see them.
Let me swap them. Now I just swapped. Now you
Great.
shouldn't be able to see them.
Yep. Now we're good.
Okay. Let's see. All right, well, let's go ahead and get started. Again, my name is Gene Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company in Oakland. We offer financial planning services. We offer accounting for small businesses. We also offer, we do taxes for folks as well. A little bit about my background. I've been a licensed stockbroker for or financial consultant for roughly 20 years, helping my clients create wealth, maintain that wealth throughout their lifetime of their children, grandchildren, etc. And I'm also a retirement counselor. And my goal as a retirement counselor is to help each and every one of you maintain your current lifestyle in retirement. What does that mean? Mike talked about how most financial planners say, you need roughly 70 to 80% of your salary, which is accurate. You don't need 100%, but my goal is to have you shoot for 100, but if you need to settle for 70 or 80, so be it. Okay, and one of the best ways to help you get to 100% of your salary is investing in Alameda County's deferred compensation program. Now, you guys work for an outstanding employer. 9 times out of 10, if you spend a significant amount of time with the county, you're looking at half your salary being paid to you, right? So you're at 50%. So if you throw in Social Security, you're even closer, right? So that's where deferred comp comes in. And the sooner you start, the better. And I'm going to kind of explain that in a little bit more detailed in a moment. Deferred comp is easy, right? You don't have to worry about writing a check or paying your bills first. If there's any money left over, putting that into deferred comp, or writing a check to Gene and have me put it in deferred comp. That's not how it works. Money comes directly out of your paycheck biweekly. You tell us either how much you want, a specific dollar amount, or what I would prefer is that you use a percent of your salary. When you use a percent of your salary, when you get a raise, it's automatically going to increase the amount of money that's going to go into deferred comp. Versus if you use a dollar amount, you're going to need to remember to go back in and increase that dollar amount that includes your raise. So percent of your salary or a specific dollar amount, it's very easy. So when you don't see it, you don't miss it, and you don't spend it. Okay, now there's a couple of ways, couple of buckets, tax deferred, tax advantaged ways in which you can invest in deferred comp. So you can invest pre-tax. That's where it reduces your taxable income, right? So when your taxable income is reduced, that saves you a ton in taxes. So if by chance you make a similar dollar amount, similar amount per year in salary, and you normally get a tax refund, well, guess what? If you put money into deferred comp pre-tax, that could potentially increase your tax refund. Now, I'm not a tax advisor. Check with your tax person first, but there is a very good chance, all things being equal, if you put money into deferred comp pre-tax, that may, in fact, increase your tax refund. Or if you're always owing every year, all things being equal, if you put money into deferred comp pre-tax, very good chance that's going to wipe out your tax bill, or at a minimum, reduce your tax bill. So you can invest pre-tax. But the pre-tax version of deferred comp works best if you believe you're going to be in a lower tax bracket when you retire, right? So you're working, you're making 100% of your salary, right? You're retired. We just talked about potentially needing just 70 to 80%. Maybe you're making less money in retirement, so it's reasonable to assume that you'll be in a lower tax bracket. Not always, but it's reasonable to assume that, right? So the pre-tax version works best if you believe you're going to be in a lower tax bracket. But some of you may say, well, you know what, Gene, that's all well and good. There is the potential that I could find myself in a lower tax bracket, but I'm not sure about that, right? As a country, we're running up debt as far as the eye can see. Despite whatever political parties in office, seems like our national debt continues to go up and away. There's going to be at some point a day of reckoning. And even though you may be right that I'm making less money, I believe I might find myself in a higher tax bracket. So talk to me if you have something where I can get the taxes out of the way today. Well, guess what? I do have something for you. If you are thinking along those lines, you can invest in the deferred comp Roth option. It's not a Roth IRA, it's a Roth 457B. How does it work? You put money into the account, it's already taxed, so it's taxed. The growth of your money is tax-free. So let's say hypothetically, over your career, you put $100,000 in deferred comp Roth, and that $100,000 grew to $500,000. That means $400,000. There's a $400,000 gain, right? That is tax-free to you, right? Now, some of you are probably cynical, thinking, how in the world will the IRS let me get away with not having to pay taxes on $400,000? There must be a catch. Well, guess what? There is a catch. Number one, you have to be at least 59 and a half. Many of you probably will hit that. You're not going to retire till you're in your 60s, so you're going to hit that. Number two, the account has to be open for at least 5 years. 59 and a half, the account's open for at least 5 years, $400,000 is tax-free to you. Okay, so that's the Roth version of deferred comp, right? We don't know for certain which one of these options are going to work for you because you're not retired yet. We don't know what the tax code is going to look like 20 years from now, 15 years from now, 30 years from now. So guess what? You can do both. You can put a little half in the Roth, half in the pre-tax bucket. So there's options for you. You can't go over the max between the two though. What is the max? Well, for 2023, if you're under 50, the max is $22,500. $22,500 is the max for 2023. If you are 50 and over, the max is $30,000. So you can put in an additional $7,500, bringing that total to $30,000. There's something that I'm sure many of you are heard of. It's called the 3-year catch-up. How does that work? Well, the IRS will allow you to put away $45,000 a year into deferred comp. Now, you can't do the 3-year catch-up and the 50 and over catch-up. It's just one or the other. So you can do provided you qualify, but you can put $45,000 into deferred comp for 3 years. You only have 3 years to do that. So the soonest you can participate in that is 54 and a half. So at 54 and a half, you can take advantage of the 3-year catch-up, provided that you qualify. How do you qualify? Well, the first step is to contact Darnell Williams. So Darnell, DARNELL.Williams@acgov.org. Tell them, hey, you sat through one of Gene's presentations. You want to find out if you're eligible to participate in the 3-year catch-up. So what he will do, he'll ask for a bunch of information from you. And how this works is he's going to go back to when you first started with accounting and see if there were years where you weren't a max contributor, right? So he's going to continue to do the math on that. And most of you have probably not contributed the max for your entire career. So there's going to be room. So for example, say you just started with accounting. The max in deferred comp was 20 grand. You couldn't afford it at the time. You didn't do it. Or maybe you took 2, 3, 4, 5 years before you even decided to sign up for deferred comp. There were years, those are years that you could have put money in that you can now, going forward, take advantage of that. So that's called the 3-year catch-up. If that is something that you're interested in, let me know. You cannot write a check to put that full $45,000 into deferred comp. It has to come from your paycheck, right? It has to come from your paycheck. Now, some of you may have money sitting in the credit union. Maybe it's not earning a whole heck of a lot, and you want to somehow move some of that money into deferred comp. Well, you can indirectly do exactly that. How do you do it? So you tell Darnell, or you contact me. We can work through this process where we take almost your whole paycheck. So we say, give me half your paycheck, and we're going to put that in deferred comp. That equals that 45,000, for example. You get paid, you don't have enough money to pay your bills. Well, you can go to your savings account at the credit union to pay your bills, right? So you're indirectly moving money from an outside account into deferred comp, right? And once that savings account dwindles down to a number that you feel comfortable with, guess what? You just go back to Darnell and say, hey, I want you to put it back to what it was before. Okay, so again, that's a way you can indirectly move that money into deferred comp. Now, starting as soon as possible is very, very important. The earlier, the better. The younger, the better. Here's an example of a participant who's 25 years old. They're looking to save towards retirement, right? This particular person, I encourage to put in $300 a month, okay? This person also let me know that they want to retire at age 65, right? So in 40 years, $300 a month, assuming a very conservative 6% rate of return, at 65, you're looking at $575,000. Okay, but let's say hypothetically, you're now 35. You didn't invest in deferred comp when you were in your 20s, right? Just couldn't afford it. I wasn't making a whole lot. I got student loan, credit card debt. I got a whole lot going on. But now I've gotten my finances together. I've gotten a few raises. I'm now 35. I now want to invest into deferred comp. But because you waited, it's going to cost you a little bit. So you're looking at putting away $500 a month. And that's just for this particular person. You may be 35. Don't assume that you should do 500. Come visit with us first so we can find out what your personal situation is. But this person is 35. They're investing $500 a month. They too want to retire at age 65. So in 30 years, they're looking at a balance of $490,000, close, at age 65, 489,628 to be exact. And here's a hypothetical example of a person who's 45. Maybe you just started with the county later, right? I'm encouraging this particular person to put in $1,000 a month. They want to retire at age 65. So in 20 years, you're looking at a balance of $455,000, right? So the whole point of this slide is, yes, we want you to start as soon as you can, right? You're at $575,000 at age 25 through age 65. But at 45, you now have a balance of $455,000, right? So We want you to start as soon as you can, but all is not lost if you're starting later in life. Never feel as though it's too late to invest in deferred comp. It's never too late. Every little bit counts. I don't care if you got 6 months until you retire. And now this is a mid-career new employee orientation. So many of you are probably on the younger side. But if you're not, that's okay. Start putting money away into deferred comp and save towards your future to supplement your retirement. Now, some of you probably have come from a different agency. Maybe you worked at Contra Costa. Maybe you worked at Napa, San Francisco, San Joaquin County, right? And maybe you have a deferred comp plan that's sitting idle at your former employer. Or maybe you work for a for-profit company. You got money in a 403B when you were a teacher, or you worked for a nonprofit, or you're in a 401k where you worked at a company and you invested money that, again, is sitting idle. You can transfer that money into deferred comp. That's considered a trustee to trustee transfer. That is, that's legal. There's no tax consequences on this transaction, provided that you do it correctly. So if that is something that you think you're interested in and you might want to take advantage of, please do not hesitate. Reach out to me. I can walk you through the paperwork. It's also important to recognize maybe it doesn't make sense to roll it over. Maybe the plan where you're coming from, or your former employer's plan, is better than the county's. I can do the homework to research that. So reach out to me. Let me know if this is something you're interested in, and we can develop a strategy to determine whether or not it truly makes sense to roll the money in. But I can tell you, in many cases, it does make sense. Really, it's really about when you're talking about the quality of a particular plan, it's about the account balance of the entire plan. Alameda County's plan is close to $1 billion. Pretty good sized plan. And when you have a large balance like that with roughly 10,000 employees, you tend to, bigger is better. You tend to get a better fee structure, better funds, etc. So consider rolling money from your former plan into your new plan. But schedule an appointment. Let's talk about it. There's a lot of talk these days, and I mention this in every presentation. There's a lot of talk these days, or over the years, about income inequality, right? Seems like rich are getting richer and richer and richer. I'm not mad at them. You know, this is America. You should come here to be able to make money, right? But then you also have folks that in the lower to middle class area of the economy that seem like we're, you know, just standing still. You know, salaries aren't rising, etc. And some folks are frustrated. But I can tell you that there are some folks within the county that was able to create a significant amount of wealth utilizing and leveraging their deferred comp. How do they do that? Well, say, for example, what was happening is 2007, there's a house that you had your eye on. 2006, but it was just too expensive. It was, I don't know, $600,000. You just couldn't afford that. But the crisis hit in 2008, 2009. That same house that was worth 600 is now worth 300. Wouldn't it have been nice for you to take advantage and jump on that deal? Guess what? There were quite a few Alameda County participants who did just that. They borrowed against deferred comp to purchase real estate. And getting that house that they bought for 300, you can guess how much it's worth now. Or if you're just looking to buy a primary resident house for yourself, you can leverage deferred comp. Leverage means you can borrow to be able to buy real estate, right? You're lending money to yourself and paying yourself back in interest. It's not like you're giving interest to a bank or to me or to anyone else. You're lending money to yourself. So it's a great tool. Some people utilize it to pay off credit card debt. Some people utilize the loan feature to pay down student loan debt. So most folks use it for retirement, but you can leverage it short term to help put yourself in a better financial position going forward. Okay, there are investments. This is where people sometimes get a little tripped up. There are roughly 15 investments in deferred comp. You have There's a stable value fund with no risk, pays around 2%. It's not a whole heck of a lot in terms of a rate of return. It's not like a Sarah that's roughly 7 guaranteed. Deferred comp is around 2. It fluctuates, but it's around 2 if you're looking for a guaranteed rate of return, right? But if you're looking to be a little bit more sophisticated and invest in stock funds, there's investments. If you, for example, if you want to invest in socially responsible funds, there's an investment for you that you can invest in. Say you're big on index funds like Vanguard, there's an investment, or there are a few investments in deferred comp that are for you, right? But if you're looking to create a diversified portfolio that reduces risk and gives you a pretty decent rate of return going forward, you can invest in small cap companies, medium-sized companies, large companies. You can invest in international investments. You can invest in bonds. So, but do your homework. Be thoughtful about your investments. Log on to AlamedaCountyDCP.com, click on investment options, and go through the fund fact sheets. Do your homework if you're looking to create your own portfolio. But many of you are not experts in the stock market and you need some help. Well, there's an asset allocation tool called GoalMaker. It's an award-winning tool. You tell us what your investor profile is. You tell us what your when you anticipate retiring, and the system will do the rest. Let's go back. System will do the rest, right? Your investor style. I'm conservative, moderate, aggressive. When are you going to retire? 65, 55, 60. And then we will create a portfolio for you, completely asset out. So it's going to have a little bit of small cap companies, some medium-sized companies, large companies, etc. It also offers automatic rebalancing. What is automatic rebalancing? Well, say, for example, you've scored a moderate portfolio that has 80% of your money in stock funds, 20% in bond funds. And say the stock market is doing really well and your 80-20 portfolio now is 90-10. Well, that's way too risky for your particular situation. Stock market did well, so your account still is a little risky. So how do we taper that risk? How do we get you back to that 80-20 mix? Well, automatic rebalancing does that. We're going to sell some of your stock funds and buy some of the bonds and cash funds, right, to get you back to 80-20. Okay. So automatic rebalancing. Another tool that I like very much is the age adjustment. Right. So as you get closer and closer to retirement, the account gets more and more conservative. Makes a ton of sense, right? You don't have time on your side to recoup any losses. So we need to take some of those chips off the table and park it in something safe, because you're going to need the money as you get closer and closer to retirement. So that is GoalMaker. So it's a great tool that you can utilize. So I encourage that. Or if you want to do your own homework and do your own investment and create your own investment strategy, knock yourself out. This is a self-directed investment account. Self-directed. This is not like a Sarah. A Sarah, you don't have control over how much you contribute. You don't have control over the investments. The county takes care of that, and that's a good thing. But here, this is a supplemental plan where you can you have a little bit more flexibility in terms of how you, again, want to invest the money and how much you want to invest. Okay, so what is next? What's the next steps? If you're not signed up, or if you want to increase your contribution, I encourage you to go to AlamedaCountyDCP.com. So that's the website. If you're not enrolled in the plan, you're going to click on enroll. The next step would be to enter your employee ID number. I believe it's your name, your email address, and then an email will be sent to you giving you instructions on how to sign up. And I would encourage, if you start this process, don't stop. Because if you stop with the process of enrolling, you're probably going to get busy and it's going to be 6 months before you actually signed up. So once you start this process, I encourage you continue, see it all the way through until you're done, right? Where people tend to get a little tripped up is the beneficiary information. I don't have my social security number of my kids or my spouse. I need to stop and let me go find it, or I'll get to it later. Here's the deal. Social Security numbers is important, but we don't need it right now. We can get your Social Security numbers later. So put the kids' names, relationship, percent that's supposed to go to that person, and keep it moving. The other area where people get a little tripped up and they stop is on the investments. I'm not an expert in the stock market. Maybe I should sit down and have a conversation with my financial advisor first, or maybe I should talk to Gene first. No, you don't want to do that. Just sign up, use GoalMaker with age adjustment. GoalMaker with age adjustment, right? Choose a moderate portfolio. Just start there. A moderate, the defaulted age is 65. So leave it 65. That could be changed, right? And keep it moving. Do the DocuSign and then sign up. Now, if you want to circle back and schedule an appointment, maybe you want to make a change to this, that's fine, because it takes almost a whole month before your first contribution takes place. So there's time to update or make a change to the investments. But we want to just get you signed up and started ASAP. Okay. Great website that you can utilize. Same great tools. Go to AlamedaCountyDCP.com. If you haven't already, if you're logged in. Oh, the other thing I forgot to mention, to increase your contribution, if you guys can see that, when you log in, it says increase your contribution. Just click on that and follow the instructions. So if you want to say, for example, go from $100 to $200 a paycheck, you want to put $200 on the form. Okay, so just put whatever the new percent or whatever the new amount is on the form when you're going through the DocuSign system. Okay, again, website. So once you've signed up, once your first contribution has taken place, I would encourage you create a user ID and password for the website, right? So on the website, you can view investment performance. You can pull down a statement. Statements come out quarterly. You can pull a statement. I would encourage using the retirement income calculator. It's a great tool. It's similar to what Mike showed you earlier through Vanguard. It's very similar to Vanguard, but it's the retirement income calculator. You'll need to enter roughly how much you're going to get from Social Security. You're going to need to enter how much you're going to get from ACERA. You'll need to enter any other retirement assets, and then boom, it'll tell you whether or not you're on track to a secure retirement. Okay, so that's the retirement income calculator. If you're already signed up for deferred comp and you've never logged in, I encourage that. Log in, create a user ID and password, but try not to get too obsessed with looking at your account balance. You don't want to look at it every day. I'd say look at it maybe twice a year. And if you have any concerns about your investments, I would encourage, before you make any moves, schedule an appointment to meet with one of us. You can meet with Mark Tomei. His appointments are predominantly over the phone. Right, so Mark Tomei with Wells Fargo Advisors. You have Jason Brummett with Empower to the far right. He does predominantly, he does some in person, but it's mostly virtual, mostly phone. And then you have myself. I'm virtual, mostly phone. So schedule an appointment to meet with one of us. It doesn't cost you a dime. This is the phone number, 855-969-4572. to schedule an appointment. Just go to that site, click on personalized guidance, and then schedule an appointment. Okay. Or you can email me if you choose to. Email me at G_Hilliard, HILLIARD, at emergefinancial.com. You can also call my office. I'm at 510-562-6355. Okay. So with that, that I believe, yeah, that's the end of my presentation. The other thing I wanted to talk about was, I'm sure some of you are a little confused about, the change in terms of, is it Prudential? Is it Empower? What's going on? Well, April 1st of this year, a transaction closed with Prudential and Empower. Empower bought the retirement business from Prudential. But I can tell you, Empower is a great company. That this is what they do. Prudential was mostly, for the most part, a insurance company. You're now with Empower. They have great tools. They have you guys covered. The website is outstanding, but you're still going to see some remnants of Prudential out there because everything hasn't moved over yet. Okay, but I just want to just make sure that everyone rest assured Empower is a good company. You're definitely in safe hands. Okay, so with that, I'd love to entertain questions. What is on your mind?
All right. Thank you so much, Gene. That was awesome.
Thank you. Absolutely.